In this lesson, we're going to see how to set up negotiated exchange rates, sometimes called forward cover, from your bank for the course of the project contract. For long-running global implementations where invoicing currency is different from the company's accounting currency, it's sometimes a practice to use a fixed exchange rate. The fixed exchange rate is used for converting the foreign sales amount to the accounting currency of your legal entity. This is usually the result of an agreement with your bank as a forward cover. The forward cover is an agreement that your bank will buy the foreign currency at a specified exchange rate from you at the end of this engagement. This can help contractors tie to uncertain global markets and heavy currency fluctuations. When fixed exchange rate agreements are negotiated, all transactions like prepayments, labor, expenses, credit notes, and all item sales and returns will use this negotiated exchange rate. Let's talk about some key terms. The two key terms that I really wanted to point out are, one, the default exchange rate, and your default exchange rate is set up in the general ledger module, and basically for every currency you can define an exchange rate. So then the second term is the fixed exchange rate, which is basically the exchange rate that you can set up at the project contract level. And this will override the default exchange rate. So whatever you set up in the GL, it doesn't matter if you have that fixed exchange rate set. So the other thing to keep in mind, and we'll just reiterate this, is that the fixed exchange rates are usually negotiated with the bank per the contract life. Let's demonstrate setting up a fixed rate agreement. Specifically, we'll define a fixed rate agreement on an existing contract. And then I'll show you the difference between a non-fixed rate and a fixed rate, and we'll do so by invoicing a couple projects. So what you're seeing here is the details of a project contract, and if we wanted to set up a fixed rate agreement, it's very simple to do so. The first thing that you most likely want to do is uncheck lock and sales currency, so you're not locking down what currency you can use. But to create the fixed rate agreement, you'll go to the project contract tab up in the action menu, and then select the fixed rate agreement button. And then from here, basically all you're doing is selecting new, defining what the sales currency would be for the exchange rate. And just an FYI, in the USSI company, the primary currency is USD. And since we don't want to transact in USD on this project, we're going to say that we're going to be working with euros. And you can see that it defaults in the ledger exchange rate that's probably the most active, so 136.98. But we have an agreement with the bank, a forward cover per se, and we'll say that it's 150 as our exchange rate, and then you can put in your forward cover number. So basically that's all you have to do to set up a fixed rate agreement, and then anytime you start getting into a billing situation, it's going to use that exchange rate over what the ledger exchange rates that you have set up in the system are. So let's demonstrate that and just show you a little bit how this works. I have a baked example ready to roll. So if I go to the project contracts list page and we look at the two bottom contracts, 108 and 109, I have one as a non-fixed rate, and then the bottom one I actually set up a fixed rate of 150 for euros. And and they're two identical situations. So I posted like 10 hours at $300 at a 300 European dollars or euros. So if I go ahead to this non-fixed rate project and we invoice the transactions that I've posted towards it, we'll see what happens here. So I'll go to the invoice proposal button at the contract level here, and we can see that there's some hours, and it's of currency euro, quantity of 10, $300 or euro unit price, or a line amount of 3,000 total euros. And you can see down here it's even translating it to USD based off of the general ledger exchange rate, which is $4,109.59. So if I hit OK, it's going to pull up the invoice proposal, and basically it's showing that this invoice is going to be in euros. So if we post, what we're going to see is we're going to have an invoice number in the invoice field, which is 145. We'll just select that invoice and we'll take a look at the voucher. So if we look at the voucher, we can see that here's the two ledger accounts it hit in euros for $3,000, but the amount that we're worried about, or the field there, the column that we're worried about, is the amount, because that's where it's translating the euros into our primary company currency, which is USD, and it translated it based off of the general ledger exchange rate. So now if we go back to our fixed rate agreement contract, and we run that same scenario, so I'll just cut an invoice. And post, you can see that we got euros again. I mean, it's our fixed rate project, it's 3,000 euros. So we'll go ahead and post, hit OK. And then from here we can review the invoice again. And I'll hit voucher. So we can see that it's no longer that $4,100 amount. It's $4,500 because it used our 150 for the fixed exchange rate. So it just basically, this functionality is a way to override what the rates that you set up in the general ledger and just have a specific rate towards project contract.